most ungrateful spot in the whole day to keep everybody awake, but we will do our best to achieve that. My name is Georg Ringe, and it's a great pleasure to chair the second panel for today, which is devoted to the theme of bank resolution. And the topic, if you read the program, is more specific than that. The theme is called Bank Resolution and Intellectual Learning Process from the Banking Union to the CMDI. And this is what we try to achieve in this panel here today. Remember, this conference is celebrating a birthday on the 10 years of the Banking Union, and bank resolution was an important part of that from the very beginning. And yet, at the same time, it has dramatically evolved over those 10 years. From the very first timid steps at the beginning, establishment of the SRB, learning how bail-in might work or might not work, to further refining it over the years, and then facing today's challenges, including renewed fears of a banking crisis in the form of a small regional banks crisis in the United States, to the Credit Suisse saga in Europe last year. So I think bank resolution is a hotter topic than ever. And I'm delighted to have an expert panel which will explore those things together with us this afternoon. Let me just briefly introduce everybody in the order as they are sitting here. First is Professor Jens Binder from the University of Tübingen. Then we have Karl-Philipp Wojcik, who's the General Counsel of the Single Resolution Board. Then we have Irene Mecatti, who's a professor at the University of Siena. And finally, Hilmar Zettler from the Association of German Banks. So you have a panorama view ranging from academic views over policymakers, over policy implementers. And I hope we get a nice set of perspectives tracing the past 10 years and, of course, exploring the most salient issues in bank resolution today. We'll proceed as follows. Each will give a brief introductory talk, and we will do the discussion for all those things together, because in this panel, I think there is more of an overlap between the different presentations, so we'll try to collect questions. So if you have a question, then please do collect it for the discussion afterwards. Thank you, everybody, and I first hand over to Jens. Thank you.
Right, thank you very much, Georg, for this kind introduction. It's a great opportunity to speak here today on the occasion of the 10th anniversary of the package that is about to undergo a major reform. Can I have the clicker, perhaps? Right, thank you. We're looking back at 10 years BRD, at 10 years SRM regulation and SRM, and we are looking back at 10 years of high expectations and lots of disappointment, or that is at least the impression that you get when looking at the recitals and the accompanying commission papers that came with the CMDI reform proposals. High expectations because it was hoped that with the BRD and the SRM, we would finally end up in a situation when failing banks will no longer need extraordinary financial support by the state. And lots of disappointments because, as the Commission repeats time and again in these proposals, the package hasn't really been used except in a very few cases, and the resolution funding arrangements haven't really been used either. And I'll give you my views on that in a minute, but let us start perhaps with a little recap on how these high expectations were formulated. In the initial Commission draft BRD published in 2012, it was said that resolution, the new world, would constitute an alternative to normal insolvency procedures and would provide a means to restructure or wind down a bank that is failing and whose failure would create concerns as regards the general public interest, and so on and so forth. Now, I hardly need reminding you what resolution is supposed to be. It's a highly complex arrangement, as I guess everybody in the room is aware of tools, the sale of business tool, the bridge institution, the asset separation tool, and the bail-in. Procedural frameworks which are different within the banking union on the one hand and the greater EU on the other hand, but are of course coordinated with one another. And this toolbox is to be applied if an institution has failed or is likely to fail, if no alternative measure, including the bail-in, is capable of preventing the failure, and indeed, and that's quite important, if resolution action is required to protect the public interest. So, which is a proportionality issue. And I'll return to that in a moment. Now, if you look a bit closer at the procedural framework, you find two essential steps, and these are important also to understand the CMDI review package. Two important steps to be carried through at the beginning of each resolution action. The first test is the failing or likely to fail test, which consists of 4 different alternatives. And the second is the public interest assessment. And the first is interesting because it refers not just to classic states of insolvency, that is balance sheet insolvency or illiquidity, but it also covers qualified breaches of authorization requirements and indeed the need of an institution for extraordinary financial support, except if that support takes the form of special types of subsidies in order to remedy a serious disturbance in the economy and preserve the financial stability. So when you look at this, you find a loophole for continuing extraordinary financial support, vulgo bailouts funded by the taxpayer already at the initial stages. Then comes the public interest assessment, which is also crucial for the understanding of the whole package and indeed for the understanding of the cases that have been dealt with so far. It provides that resolution can happen only if that resolution is necessary for the achievement of and is proportionate to one or more of the resolution objectives, and if indeed winding up of the entity under normal insolvency proceedings would not meet those resolution objectives to the same extent. So resolution, according to this original wording, is reserved to a few cases where insolvency basically doesn't work. Now, where does this lead us? And I refer you to the very informative Commission staff working document that accompanies the CMDI reform package, where you find a full assessment of all bank failures that have happened since 2014. Let me just highlight a few of them here, which are basically those dealt with under the auspices of the new arrangements that took place in 2014. First is actually one example of a bank that did not go into resolution, but that was resolved using one of those loopholes, namely the loophole for precautionary recapitalization. The second case listed here was then the first resolution case, namely the resolution case of Banco Popular Español, and we will hear more about that later, I understand. We then had a few cases in a row where it was decided that even though the relevant institutions were failing or likely to fail, resolution was not actually necessary, thanks to the application of the public interest assessment, and so were handed over to national authorities for liquidation under the national laws, which in the Italian case did involve the provision of state aid, which was in line with the wording of the directive, but contrary to what many describe as the underlying policy objective, rightly or wrongly, and I leave that to you for the moment. Same happened in the case of PNB Banca without state aid support, and then we had another resolution case in 2022, a special case though. Now, I'm not going to discuss these cases in detail. I don't have the time to do that, but I just wanted to give you the general idea, and the finding that we get here is that indeed the minority of cases actually resulted in outright resolutions rather than other solutions. In comes the CMDI review package, consisting of these three proposals: a proposal for a regulation amending the SRM regulation, another one amending the BRD, and finally a proposal amending the DGSD. And you will hear more about this from my fellow panelists. What I want to highlight here is what I find to be a surprisingly clear shift in paradigm. If you read the Commission formulation of the rationale behind this package, it's not just a minor reform to address technical shortcomings of the earlier package. It is indeed far more ambitious. If you look at this, you read that to date, many failing banks of a smaller or medium size have been dealt with under national regimes, often involving the use of taxpayer money, instead of the industry-funded safety nets such as the SRF in the banking union. This goes against the intention of the framework as it was set up after the global financial crisis, which involved a major paradigm shift from bailout to bail-in. In this context, the opportunity cost of the resolution financing arrangements financed by all banks is considerable. Now, what this says is basically we invented a machine. The machine hasn't really worked well so far, wasn't really accepted by the industry and by authorities, so let's make its use mandatory. In more detail and in greater fairness, admittedly, to the intentions behind the package. And this is my final slide, and I'll be done in a moment, Georg, don't worry. What we see is a mix of measures. Okay, not yet, yeah. It will become critical, hopefully. Well, if you look at the package in some detail, you find a whole mix of different measures anticipated here, and it's impossible to come up with one final judgment that would capture all of them, because they're all different, and some of them are absolutely laudable. Others, perhaps, we might view a bit more critically. What I greatly applaud is the reform proposal as far as the early intervention powers are concerned. These are reform proposals that basically remove technical inconsistencies, technical shortcomings of the existing package. I won't discuss this here. Then comes the major reform step, a reformed public interest assessment, whereby insolvency liquidation in the future would be admissible only where it would meet the resolution objectives more effectively. Now, what does that mean? Well, essentially, as far as I can see, even though this is not expressed as clearly, we want resolution to become the new norm, the rule, rather than the exception. And that's just the reversal of the initial approach that I characterized before. And the reason for that is, or one of the reasons for that is apparently that the Commission isn't really happy with the fact that national insolvency laws were used as a sort of a sideway in the past in order to facilitate government-funded subsidies, resolution subsidies. Italy is a showcase for that, something which wouldn't have been possible to the same degree, at least under the BRD. Now, if that is so, one might well ask, and I'm happy to discuss this further in the discussion, whether we shouldn't focus on further restrictions on government subsidies rather than, turning what used to be the exception into the new rule, which comes with all sorts of problems, which I'm also happy to discuss later. The third step then is a reform of the MREL requirements, and we'll hear more about that later. And finally, and this is again something which we will hear more about in due course, there is a rather major reform of the DGSD on the table, which is supposed to change the way DGSs are used in resolution in a number of respects. It will greatly change the current insolvency treatment of DGS claims in resolution and in insolvency. It's supposed to, or meant to, expand the use of DGS funds as a resolution source of funding. It's also made to make sure that there is a sort of a bridge to the use of restructuring resolution funds and the single resolution funds. And this is something technical that I'm sure we will hear more about in a moment. My final point on that, and then I'm done, is yet another question. This is all very impressive, and it might, if enacted, change the world tremendously as far as DGSs are concerned. But it rests on a number of assumptions, in my reading at least, as to the availability of DGS funds and the usefulness of these funds and the DGS's ability to replenish after being used in one or more cases. And whether these assumptions will hold true, only time can tell. I'm rather skeptical about that. Thank you very much. That's all from my side so far. I look forward to the discussion.
Thank you, Jens, for this wonderful high-level introduction into the background and the current situation we're in. We now move to Karl-Philipp, who will talk to us a bit about the practical view, the real-life experience of what is going on. We look forward to your talk.
Thank you, Georg, indeed, for these nice introductory words. Thank you again also for inviting me here to the annual EBI conference. It's a real honor to be among such an esteemed global group of lawyers and others. My special thanks also to the EBI organizers for this program. I think it's a fantastic program. I recall myself participating 4 years ago in February 2020 to the last annual EBI conference. As you remember, this was just before the lockdown started. And I'm really happy that 4 years later I can be here with you, all of you, however, in a vastly different world, I would say. And that's why I also want to discuss something which at the time we were not thinking about. This is the CMDI proposals, to be a bit more trivial. Please note also from the outset that these are my personal thoughts and they do not bind in any way the Single Resolution Board or any public authority. As Jens, you have said already, the CMDI proposals, they stem from the experience gained over the last 8 years, I would say, of the application of the new framework. They respond to the banking union's incomplete progress, and that was, of course, also acknowledged in 22 by the Eurogroup. And let me maybe clarify first what the CMDI is not before saying what it is actually and what it does. The CMDI is not a response to the banking turmoil of March last year. However, the turmoil clearly provided some needed political momentum to get these proposals adopted. And maybe that proves once again something which is very inefficient, frankly, that most often one needs some painful crisis to accelerate certain consensus in the policy area. Not very efficient, but I think that's how it is. The CMDI also does not complete the banking union, and it does also not complete any or all issues which you can have in this context. So liquidity and resolution, just to give an example, is not covered by these proposals. But nevertheless, the CMDI proposals, in my view, they mark a crucial step by policymakers to addressing both resolution and deposit guarantee system matters holistically and in an intertwined way. Having said that, let me turn now a little bit to the substance, and I would like indeed to illustrate some of the practical challenges which I think the system has faced over the last 8 years in order to better explain why certain changes have been made. And I'm doing, of course, a selection, obviously. And I would like to start with funding. So if we step back, so what are, in an abstract way, the possibilities to fund resolution action when you have to deal with losses or liquidity? In a very abstract way. You can simplify it, and you have two options, basically. Option one is internal funding with internal resources by shareholders and creditors. And the option two, and there are certain sub-options, option two is external funding. And there are certain different external funding sources. You can have an acquirer of a bank, for instance. You can have external funding by industry-funded safety nets. You can have central banks and emergency liquidity assistance as some sort of external funding, and you can also have taxpayers' money as an external funding source, I think. Abstract way we can say this. Of course, the last option here, taxpayer money, is an option which is discarded in the banking union. Although, Jens, you have mentioned it, in the case of the two Venetian banks, we saw that through the back door, somehow, liquidation aid was granted. I think also I don't want to talk about ELA and central bank funding here at this stage. I also don't see Rosa Lastra here, so I don't want to go into that. Basically, it leaves us with internal funding options or funding options through an acquirer or industry-funded safety nets. Talking about the internal funding option, this is nothing else than write-down and conversion of shares and liabilities, the instrument of bail-in. We could spend probably an entire seminar on that. I don't want to do that. I just would like to mention that to make that option work, thorough preparation is necessary. MREL needs to be there. There needs to be good cooperation between authorities, particularly in a cross-border context. And that can be challenging, but I think the good news is also that over the last years, we have made in the banking union very good progress on that. And I think the case of Banco Popular, which was already mentioned, is a case in point where not the bail-in tool, but the write-down and conversion instrument was used and was successfully used, and I think has been also in the courts upheld up to now. So I think this proves that the tool can work. When it comes to external funding through an acquirer, I think this has worked in also the two resolution cases the SRB had to deal with, Banco Popular and Sberbank. There we had the transfer tool of the sale of business, which was used, and the acquirer was providing the necessary liquidity from day one after the weekend or after the night in the case of Banco Popular. But obviously, this tool can only work if there is a willing and if there is a suitable buyer. And that is a bit of a practical issue sometimes because, if you don't have it, what can you do? And I think the Credit Suisse case in Switzerland shows also that to a certain extent, this option may be a little bit less available now in Switzerland when it comes to this big GSIP. And that brings me to option 3, which is the external funding through industry-funded safety nets. And that is in the European Union, in the banking union more specifically, the Single Resolution Fund on the one hand, and the national DGSs. And here I would like to talk about the practical issues which we have encountered when talking about the Single Resolution Fund and also then the national DGSs. So I would like to mention 3 practical issues with regard to the Single Resolution Fund. First of all, looking back over the experience of 8 years, let's not forget that over the last 8 years, the fund first had to be built up. That means that in 2017, let's say, the year when Banco Popular was resolved, this was only 2 years that the fund had been filled. And I think that shows you that the available means at the time were miles away from the target level, which we have actually attained this year. So the fund is now fully funded. But at the past, it was of course not the case. The second practical issue is the fact that in principle there is a 8% requirement of prior losses, of prior internal loss absorption to access the Single Resolution Fund. And the practical issue here is obviously, is there enough loss absorbing capacity in a certain bank in order to unlock the access to the Single Resolution Fund? And what if this would be the case if this was only the case if you were to touch depositors? The second question. And that, of course, is the big elephant in the room. I mean, the 8% in case of certain depositor-based funding models, even if you have fully MREL compliant banks, can be, in case of smaller and medium-sized banks, a challenge. And the third practical issue with using the SRF is actually a procedural one. You know that there is a prior commission approval necessary in the course of the weekend for having this internal, this fund aid approved. That can be quite a challenge. Huh? I mean, we have operational and working arrangement in place, but still, before the resolution scheme can be adopted, there needs to be prior commission approval of the use of the aid. So 3 small issues regarding the use of the single resolution fund. Turning now briefly to the DGSs. So they are industry funded, but they are national. And the interaction with the European level here, with the single resolution fund, in the past has not always been easy to predict. And I think DGSs were also mainly used in liquidation in their basic payout function. The CMDI aims to improve funding options, and in particular wants to address the issues which we see with SRF use and DGS use. And it does so in various ways. I want to pick out 3 of them. First of all, to achieve the goal of addressing these practical challenges, in the original Commission proposals, changes to the so-called least cost test have been proposed, and they aim to favor the use of DGSs for resolution versus liquidation. And that is done, this was already on one of the slides, is done by creating only one single class of depositors in the insolvency ranking, doing away with the super preference of DGSs, treating all the depositors pari passu. So basically, the liquidation counterfactual is made costlier to unlock DGS funds. These changes here, I could go into the details, but I don't think it is necessary now. These changes are welcome on the side of the SRB. But the single creditor hierarchy is very controversial politically. It's a matter of fact. And even with the new CMDI rules on the least cost test, the process would still be rather convoluted if you looked really into the detail and check the interaction between the national DGSs and the single resolution fund, which again, in times of crisis, may not be very, very helpful. We see a little change when it comes to this more administrative question of the Commission approval. So the Commission has proposed that the Single Resolution Board can go ahead with a resolution scheme, and that this approval needs to be only there at the end of the process. I think this is already welcome. Still a challenge, but it's already clearly an improvement. And the third element, already mentioned briefly, is the so-called DGS bridge. The CMDI proposes that interventions made by the DGS in resolution would count towards the 8% requirement. That would have the effect that the access of the SRF might come easier than today. Although also here challenges remain, and the bridge provided by the DGS may in some cases not be big enough actually to unlock the access to the Single Resolution Fund. One major concern which we have heard from industry and also in the political arena on this is that the DGS bridge would actually weigh on the finances of DGSs and the SRF. I think we think that this concerns are a little bit overblown. A recent study, which is also available on the SRB website, shows actually that the impact on the finances would not be that, would be rather limited. And that is because the number of banks for which the bridge would not be there is, for the banks which would need the bridge, is rather small. And of course also MREL remains still the first line of defense. So I would like to stop on funding here. I have one Ceterum Censeo, which is national insolvency regimes. There is a lack of harmonization, and that creates a lot of issues in many respects when it comes to the public interest assessment, when it comes to no creditor worse off, when it comes to liquidation aid through the back door. This is basically all the consequences of a non-harmonized European liquidation regime. But I don't want to get into these details. I want to conclude. And I would like to do so by saying that the CMDI package is really an important step forward for the European crisis management framework. And it is based on the experiences so far and the lack of progress on the completion of the banking union. I would say CMDI is more evolution than revolution. And that also means that maybe not everything is perfect or politically agreeable yet. That's also explaining why legislative negotiations are still ongoing, as you all know. The SRB chair says often in this context that, however, this reform is important to send a signal of trust into the resolution framework and in the banking union, and ultimately is meant to make sure that the resolution toolbox is as complete as possible. And whatever compromise the legislators should find on the various controversial points, and in particular on the funding option, which I put at the center of my presentation today. So whatever compromise, the legislators should make sure that it delivers similar results to the Commission proposals. What do I mean with that? If the scope of banks under the SRB's remit is expanded, and for instance the PIA is expanded, we need to have sufficient financing, and in particular through DGSs, so that the resolution tools and the resolution actions can be put in place. I would like to stop here. Thank you very much for your attention. I'm looking forward to our discussion after the other presentation. Thanks a lot.
Thank you, Karl-Philipp. My ceterum censeo would be you've done a wonderful job in highlighting, may I say, a few aspects of the reform which are less in the perennial discussion. So this has been extremely helpful, I think, to shed some further light of what's going on. And I'm sure that we'll come back to that in the discussion. But hold your breath. Collect questions for later on. We move on now and hear from Irene about the shift in focus that's going on in resolution to move more to address smaller banks, which is, I think, the policy paradigm of the hour. Irene.
It's a pleasure for me to be here. I see that all this stuff is made for tall people, so I try to see that I'm very short. And it's a pleasure for me to be here after 4 years. I was here also in 2020, and when I came back to Italy, I found a man with a COVID suit. He was testing me, and after 10 days, we had the great lockdown. That in Italy, as you may know, has been really, really tough, in particular for people like academics that have this kind of isolated world, and we live always at home studying, and so they jailed us mainly, so the only excuse that I had to go out was to go with my dog. Now, from a sanitary crisis to banking crisis, my topic is the crisis management of smaller banks. Of course, it's a wide topic. It's very technical, so I'm not going to go into so much details. I will try to give you some flashes, some idea of my idea on the CMDI reform, because this is the main topic of the CMDI reform. Now, as Jens did, we have to start from the general settings of the BRRID. The BRRID refers to the word crisis more than 50 times, but it does not define it, which is peculiar because in Italy, in an Italian system, we have 3-4 definitions of crisis, depends on the level. And, but we have a definition of systemic crisis. And the general setting is that all the financial intermediaries might be systemically relevant at some extent. So this is the reason why we have the famous one size fits all, in the sense that all the banks are subject to the SRM framework despite size and complexity. But when we come to the resolution that with the tautology is defined like the application of resolution tool that Jens highlighted before, we have to respect two conditions. First of all, the banks has to be failing or likely to fail. So in this context, the concept of crisis coincides with the concept of failing or likely to fail, and then there must be a public interest. In fact, this is the general framework. In order to avoid moral hazard, any failing institution should, in principle, be liquidated. But when the liquidation may jeopardize the financial system, may imply the use of public funds, may interrupt the provision of a critical function of the bank and jeopardize the protection of depositors and other clients of the bank, there would be the public interest. So the dichotomy between resolution and liquidation is the public interest, which is evaluated by the resolution authority. Now, after 10 years, we can say, of this new regime, we can say there are reasons for inefficiency. I identified all three. I mean, the main one is, the first one is also what my colleagues before said, is the coexistence of a common European resolution framework with numerous heterogeneous national insolvency law that are different not only for objectives and conditions, but also according to the procedural sides are very different. Then we have a strong rigidity, a very lack of proportionality in the condition of access to resolution, and its internal, I refer to the MREL, and external financing. So there's a really lack of proportionality in this field. Thirdly, the highly restrictive approach of the SIB in evaluating the public interest as a condition of resolution for resolution at an European level. We had only 2 cases, and then I will show you in the next chart. The next chart, we had a lot of banking crises. We cannot say that we didn't have them, but only 2 cases of resolution, and the other cases, in particular, the management of the crisis of those non-systemic banks, but not necessarily less significant institutions, have been managed at national level, and often with the use of state aid. And when I speak about state aid, I don't refer only to public funds, because according to the BRD, state aids are also the use of the resources of deposit guarantee schemes and the use of resolution funds. At least they are evaluated according to this, to the law of state aid. As Karl-Philipp also stated before, that you always have the approval of the European Commission, and this is a problem. It's a big problem that is not going to change with the CMDI reform. And we have also to consider that, according to me, the system gives a sort of incentive to manage the crisis at the national level, also because how I call it, the state aid burden sharing, which is embedded in the banking communication, is less restrictive than the bail-in, because it involves the contribution only of equity, capital instruments, and subordinated debt. This is the chart that I told you before. It's not so clear, but I can circulate my presentation later on. So, given this backdrop, my agenda is very small. I will try to identify the notion of a smaller bank. Secondly, the reason for the relevance of this kind of intermediary in the real economy. And thirdly, I will give an idea of the specific areas of the CMDI that are and should be, according to me, subject to reform. Now, the notion of smaller bank, we have to say that there's not a definition of a smaller bank within the CMDI. We have a definition of medium, small, and non-complex institution within the prudential supervisory framework. And this is this framework that is recalled in the distinction between significant and less significant institutions, and is also recalled by the EBI in a study of 2021. Is the response to the CMDI reform, which classify institutions as large on one side, medium and non-complex on the other side, according to the total assets below euro 30 billion. But, and that here we will come to the problems. A smaller bank normally, it's not only a question of size, as a business model, primarily based in terms of funding on retail deposits, which means that all the banks have to respect the MREL, a minimum requirement of eligible liabilities. And these MREL are calculated by the resolution authority with criteria that they appear very adjustable. If you read the SRM regulation, it's written that the business model, the funding model, the risk profile of the bank has to be taken into account. In reality, and this calibration is apparently adjustable for two reasons. First of all, the bar has been kept very high and by the resolution authorities in general, and we see that we have a lot of legal challenges pending in the European courts, but also in the appeal panel cases that I checked that are also regarding proportionality and MREL. Secondly, and this is the thing that also, point that also Karl-Philipp mentioned before, is the 8% till-off. Every bank, if wants to access to external resolution financing, resolution funds, deposit guarantee schemes, and whatever, has to apply a bail-in of at least 8%. And this is an indirect limit that is very difficult to respect for the smaller banks. In fact, smaller banks in general have difficulties in placing sufficient MRELs. In the past, they did it a lot to the detriment of the customer, with the unfair practice of mis-selling that we experience a lot in Italy, but not only in Italy, which brought to the introduction of Article 44A of the BRRD and other limits on the placement of subordinated liabilities. Then, banks with high reliance on deposits are supposed to rely on unprotected depositors to reach the 8% till-off. And in this study of the EBA, but also these things are written also in the report that is attached to the reform, in a more severe scenario, SIT1 scenario, 70% depletion of the capital buffer, some institutions may not even be able to meet the 8% till-off, thus jeopardizing their ability to access external resources to manage the resolution. So, what are the reasons of the importance of the smaller banks in the real economy? Since the global financial crisis, the euro area banking market has become increasingly concentrated due to reason of maintaining financial stability, improving profitability and efficiency. In Italy, of course, you know that we have also the reform of the cooperative banks that now are merged in big groups, and they became less significant institutions. And then, in the report of the Bank of Italy, but also the ECB, I reported the dates here, you see that we have a decrease of the number of intermediaries in the real economy. What are the negative sides? First of all, the too big to fail problem, because if the single resolution mechanism had the goal to avoid the use of public funds, the too big to fail bank will pose this problem again. Secondly, we have a lack of intermediaries that have a contact with the territory. In Italy, for example, 1 in 3 municipalities does not have a branch, so there's a lack of access to banking services. And this can bring to another point, according to me. If we consider the case of the Silicon Valley Bank, this was a medium size according to the US standard, okay, bank, not according to our standards. But the crisis of the Silicon Valley demonstrated that a limited territorial network, this bank had only 70 branches, only 17, may not allow for an adequate fractioning of deposits, thus exposing the intermediary to the bank run of large uncovered deposits. And then, this is the narrative, the last point is the narrative of the CMDI reform. Smaller banks when are exposed to the same risk factors, can be systemic altogether, and they can give to rise to the point of the too many to fail. How the CMD package tried to tackle these issues? There are two main areas. The first area is the public interest assessment. So behind these 3 points, there are the case, when I read it, I saw the Veneto case, the Veneto Bank's case behind all the 3 points. First of all, the definition of critical functions. Now the resolution authority can take into account also the effect at the regional level, not only at European national level. There are adjustments to the resolution objectives related to the minimized reliance of public money. So here there is this distinction. Public money, when are public funds, it's one side. When are funds that come from private funded safety nets, like resolution funds or DGS, is different. And thirdly, it's interesting, I think the procedural change in the comparison that the resolution authority has to do when it compares between resolution and liquidation. If liquidation implies the use of a state aid, okay, the PIA must be considered present, in the sense that there will be a public interest. Then we have the watering down of MREL. Normally smaller banks have, as a resolution strategy, have the sale of business. So the calibration of MREL is, there's a watering down of MRELs for banks with transfer strategies. They don't touch the 8% TILOF, they still remain. And then there's the intervention on deposit guarantee schemes that also Karl-Philipp recall. So the DGS should function like a bridge to reach the 8% TILOF. They could cover also uncovered deposits, but it's a very technical and difficult procedure because it is decided in a case by case by the resolution authority, and there must be the exemption of bail-in. So there must be a reason that's not easy to find as well. And the other point that is very important, I think, is the introduction of the single depositor preference in the ranking of claims and insolvency laws, which will replace the super priority that we have. And now I come to the open issues and my conclusions. Of course, the expansion of the resolution will imply that smaller banks may fall under resolution more easily. Of course, they will increasingly be subject to MREL. But the reform will not touch the 8% TILOF. That I don't say that has to be deleted, but at least it could be adjusted according to the business model, the funding model of a bank. And if deposits have to be bail-in, this requirement may raise financial concern. I agree with the reform of DGS, although, as I told before, I think that this function has to be more predictable, in the sense that if every time the resolution authority has to say if we apply this rule or not, there will be a lack of predictability, which is essential in any bank crisis prevention resolution planning. And then we have this point is important, that the dichotomy between resolution and liquidation implies also that liquidation becomes less attractive. So we should reform the difference in the burden sharing that we have in the state aid and the burden sharing that we have in the bail-in. And last but not least, and I come to my conclusion, the third pillar is missing. And if the resolution will be extended, also the DGS will be involved more in the resolution financing. And the third pillar will be essential, or at least to finance the national DGS when they will exhaust their resources. Thank you very much.
Thank you so much, Irene. I think one of your first comments was that there is no definition of the crisis in the BRD, and that you have, however, 3 different definitions in Italy. That reminded me a bit of, the story about the Inuit, who have about 50 definitions of what snow is, right? So maybe after all, it's a good sign that we don't define what a crisis is. But jokes aside, thanks so much for a wonderful illumination of the problem of the small banks, and I'm sure we have a lot of things to discuss later on. We now move on to hear from Hilmar what the banking industry is thinking of the proposals, or at least your organization, and we very much look forward to your thoughts.
Thanks a lot for the kind introduction, Georg, and many thanks to the organizers for inviting me. It's really a great pleasure to talk to you this afternoon, and not just maybe give the view of the industry, but also of the DGSs, because probably you know, as association in Germany, are responsible for the management of a private and mandatory scheme too. And I can say that many of the views I would like to present now are shared by almost all of my colleagues in other countries and other DGSs. So I would say maybe not every point that I mentioned today is a European DGS point, but we studied the current proposal intensively at the European Forum of Deposit Insurers, and there is a relatively similar view on this proposal. So let me start maybe with some more general remarks, some thinking about the general principles that should guide us when we talk about financial regulation, especially the post-financial crisis regulation. Especially when I remember the discussion in the last month or the last year after the SVB, sometimes I had the impression that these principles are not valid anymore, and I think they are very, very important when we think about the next steps in reforming DGS and resolution in Germany. Probably the most important guiding principle, at least when I think of the German politicians, is that we do not want bailouts anymore. No more bailouts for banks. Taxpayers shall never pay for rescuing banks. This is when you talk to the Ministry of Finance about what purpose ever, is really the most important guiding principles. No taxpayers' money. We shouldn't calculate or trying to rescue banks with taxpayers' money. The next point, and this is very important from my perspective, every bank should be able to leave the market. This is a fundamental principle if we follow market economy. All we did after the financial crisis is not because we think that we are in favor of bigger banks or bigger banks deserve another treatment or better treatment or whatever. The rules we introduced after the post-financial crisis was because of the experience that the procedures in place are not appropriate for systemic relevant banks, but it's not to protect the shareholders or the banks itself. So for me, it is still valid that every bank at the end of the process of a DGS rescue, of a resolution process or whatever, in principle, a bank should be able to leave the market. And there are two very important constraints. This is very clear. Uninformed depositors have to be protected. That's the reason why we changed the DGSD in Europe in 2009, directly after the financial crisis already, and in 2014, a second time. We increased the coverage level, we reduced the payout period, we abolished the co-insurance, so we improved the position of the depositors strongly, and was mentioned earlier, are the 100,000 euro for depositors in Europe still appropriate? Something probably that will be discussed more in detail, but the EBA study was mentioned already, and we delivered a lot of data as DGS for this research, and the result was that in principle we do not need an increase of the coverage to improve the protection of depositors. So, and the second point I mentioned already is the common knowledge that we need a special regime for systemically relevant banks. We learned that insolvency is not applicable, and that we have to prevent contagion. And so I think the implementation of the Single Resolution Board, of the resolution mechanism in Europe, is a big achievement for appropriate treatment of the systemic relevant banks. And another important point from my point of view is burden sharing. There's no free lunch for shareholders or investors. When we discussed the expansion of the protection in the last months, sometimes I had the impression that every depositor, every investor in a bank, in principle, should deserve a full protection, or that nobody shall face any losses when dealing with banks. Banks are corporates, they are companies. So in principle, they follow the same rules than if you make business with them than other companies. So for me, these principles are very important, and especially when we talk about the expansion of the protection, because finally we are talking about costs and who will cover the costs. And at the end of the day, probably customers and taxpayers have to bear the costs. Maybe just these few remarks as some general introduction. On the next slides, I would like to talk about the status quo with the current challenges. And for me, it is very, you know, I'm a practitioner, we are running a DGS, so I have a practical view on the problems. So what are we talking about? And I'm now showing you the German perspective. The mandatory deposit guarantee scheme in Germany covers 180 banks. 50 banks of them belong to, let me say, resolution group already now. These are the big banks in Germany, daughter companies of other big European banks that have daughter companies in Germany. So in principle, those 50 banks are covered by the single supervisor mechanism and the single resolution board already. The rest of the banks are 130 banks that are primarily managed by our DGS on the national level. And when I look at the size of these 130 banks, then 90% of them have a balance sheet below 10 billion euro and much less deposits. And 80% have a balance sheet of below 5 billion. So we are talking about a lot of relatively small institutions that can be handled by the national DGS, by our DGS, without any problem. Looking at the compensation process, look about the financing. But we have to say there is a small number of banks, let me say something between 10 to 15 banks, where it is rather unclear if they belong to the DGS or rather to the resolution mechanism, if we can handle them, probably not, or if the resolution tool would be more appropriate. So when I look at the total number, then probably I have maybe 10 to 15 banks where we have a problem that has to be solved with further regulation. And on the other hand, we learned that sometimes a surprise for us, that not every bank that is covered by the single supervisory mechanism will be 100% sure managed by the single resolution board. This is something probably we have to discuss too. For us as DGS, there's absolutely no clarity which institutions falls under the competency of the SAB or of the DGS. In principle, we have to cover every bank as DGS, even if everyone knows that, for example, we will never compensate the Deutsche Bank. So, but there is unclarity for a limited number of institutions, and for those institutions, we need more or different rules. Now, let me give our view on the CMDI proposal, and for sure this is a well-known German view. You know that the industry and the politicians in Germany have a rather critical view on the CMDI proposal. We think, as I said, that we need more clarification where a bank, a financial institution belongs to the resolution regime or to the DGS. The current treatment of the public interest test is not optimal from our point of view, so we support the approach to work on the change of the public interest test to get more clarity who is responsible for what institution. A very, very critical point in the proposal is the scrapping of the super preference. This is really maybe for all, and not only for us, for most of the DGSs in Germany. The super preference for covered deposit is, from my point of view, one of the biggest achievements of the post-financial crisis regulation. When we scrapped the super preference, we put the financing of DGSs in danger, and we will increase the damages for the DGSs substantially. Because the lack of super preference will not only be valid for cases where maybe a small or medium-sized banks goes to the Single Resolution Board. For all our other compensation cases, this would be valid. So our costs would increase substantially, and the financing needs too. So we are really completely against this. As I said, we think that we need more clarity where banks belong to which regime they belong to. But we do not share the view that we need an expansion of the resolution regime to smaller and medium-sized banks. We just have to say, does it belong to the resolution regime or to the DGS? But a general expansion of the resolution regime managed by the Single Resolution Board to smaller and medium-sized banks is not necessary from our point of view. And so we think that a bridge financing of DGSs for getting banks to the Single Resolution Board and for the usage of the Single Resolution Fund is the wrong way from our perspective. We have resources in the Single Resolution Fund for resolution. We have resources for national payouts or national alternative measures, and we should use the financial means that are dedicated to the specific purpose. We hear often in the last year that, especially in the aftermath of the SVB case, that another positive aspect of the CMDI proposal is the expansion of the protection, not just for covered deposit, but for much more depositors. We are not in favor of such a change. We do not think that we really need this expansion. We do not think that deposit insurance is the right tool to solve the problems we saw with SVB, and so we have a rather critical view on this implicit extension of the coverage. Another important problem for the vast majority of our banks are a lot of additional burden for banks that are highly regulated already. I'm talking about small and medium-sized banks. If the current proposal becomes reality, then many banks in Germany and a lot of small and medium-sized banks will have to work on resolution planning. At the moment, the majority of them, the preferred resolution is insolvency. A lot of them have to prepare resolution planning, and we need loss-absorbing capacity for small and medium-sized banks too. And this will be a substantial additional burden for small and medium-sized banks. But I want to mention one positive point too. We see, when we look at not at the SRM and the BRD, but at the DGSD proposal, we see that we find there are a lot of technical proposals that come from the 3 EBA reports that were written 3 years ago. We see a lot of important improvements there, more technical improvements, but for us as practitioners, very important. We are a bit frustrated that, as I said, these recommendations of EBA that are 3 or 4 years old do not come into reality because we are always dealing with the very big things. We would really welcome if the DGSD, the technical points in the DGSD would come earlier than later. I would like to come back once more to the point of super preference. I took the example of Greensel. Maybe you know that we had the insolvency of Greensill in 2021. It was a damage for the private and mandatory DGS of around 3 billion, and our mandatory DGS, that is ruled by the DGSD or our national law, had to pay around 1 billion. Before the Greensill case, we had contributions of around 480 million euro. With the Greensill damage of 1 billion, we had to refill our fund and we had to reach our target level in 2024. And we had an increase of contributions from 480 to around 800 million. So really a substantial increase in contributions and financial burdens for the industry. In principle, probably without the super preference, we would have stayed at that level for the rest of our the time until reaching our target level. But because of the super preference, we had very quick repayment from the national insolvency procedure. We got the first money out of this insolvency procedure in 2021, so at the same year where the damage happened, of around 400 million. Today, around 3 years after the Greensill insolvency, we covered 900 million euro out of the bit more than 1 billion damage, and we hope that we will get fully recovered in the course of this year. Without the super preference, it would have been impossible that we get so quick and such a huge repayment, and this is the reason why the super preference for us as DGS is so important. Let me come to my final points. What is from our perspective as practitioners that have to work with the current regulation, what are the most important points? We think that in principle, the current framework or the crisis management framework we have already is appropriate. We learned a lot during the last years. I think when we look at the DGSD, at the DGS regulation, we made big progress during the last years. When I look back at the implementation of the DGSD and the state of development of the DGSs all over Europe now, this is really a big progress. And I remember at a conference of the European Forum of Deposit Insurers, the representative of EBA said, the DGSD and the improvement of the DGSDs in Europe is a big achievement and a big success stories. We had almost 100 cases handled by DGSs. And how many of them do you know? And the case that you do not know them is a sign for the success of the DGSs. We have problems in the resolution regime and the interplay between resolution and DGSs, but this is, from our point of view, not a justification to change the whole regime once more, and the CMDI proposal is a fundamental change from our point of view. I said already, the clarification, where does a bank belong to, is very important. I don't want to talk about this once more. From the perspective of a practitioner, we do not need more complexity, and with the CMDI proposal and the additional regulation that is linked to this proposal, we will get much more regulation. My impression is, when I look at the last cases, the experience, how these cases were handled, how the institutions work together, we really need a reduction of the complexity. We still have a vast majority of rules that are untested, where most of the people do not know how to handle them in a real severe crisis. So not more complexity, we need less complexity. Another point that is really important from the practitioner's view, and this is, from my point of view, really underestimate is the importance of cooperation and coordination between the national and European institutions. And we saw it, I think a very good example was the Sberbank case, where a lot of institutions on the national, on the European level were involved. From the supervisory side, DGS side, resolution side. And this was, I think finally it worked, but this was not a smooth process. And I don't want to imagine how this would work when we not have a bank like Sberbank, principle from the economic point of view in a good shape without big problem, when we really have severe economic challenges. The technical improvements are welcomed, I said it already. When we think about the further development, we would recommend let's go forward step by step. We saw it 2 years ago, or when we look at the CMDI proposal, as I said, we think it's very far-reaching. It is far-reaching, but we had the year before the Donahue proposal, or the far-reaching proposal of Donahue the year before failed. So the perception is that at the moment there's not enough political will to really establish EDIS or to do a big step forward. So let's go step by step. For example, let's discuss a kind of liquidity support on the European level or whatever. For us, as practitioners, it would be much better to go step by step to improve the current system, but not as we did during the last 8 years to discuss the same proposal for many, many years without any substantial progress. Then, it was mentioned already, do not forget the state aid issue. When the Commission started the review, they started the review of the state aid proposal of the Banking Communication 2. I didn't hear anything about that during the last weeks or months, but it's very, very important when we talk about resolution or alternative measures on the national level. And my last recommendation, pay attention to the distribution of the competency between the different pillars of the banking union. As I said already, when we talk about SVB and the learnings from SVB, for me this is more a learning from the supervisory side than from the DGS side. Because what happened in the US, what's happened in Switzerland, was not following the rule book we have. We did not see, for example, bail-ins when we look at the US. We saw extraordinary measures and so on. This is, from my perspective, not how we want to see cases handled. And when we look about improvements and how to deal with problems similar to the SVB problem, then it's more a supervisory problem. We won't solve this with expanding the coverage of DGSs without limits. Thank you very much for your attention.
Thank you very much, Hilmar. And this critical view is very welcome because it spices up the discussion, if you like. Now, we want to open the discussion as soon as possible. I see already a couple of hands, but before we get there, let me abuse my chair's privileges and ask a bit of a provocative thing to all of you, because there is something that united your different talks, and that is that very frequently the legal framework that we have built over the last 10 years, and the legal framework that we are celebrating today with the 10 years of the banking union, hasn't really been applied, has it? Right? I mean, in a way, if you think about it, we've built this wonderful new regime of bank resolution, and we have a few lessons learned, yes. We thought, the lesson was we focus on the big systemic banks, and comes 2023, we see, oh gosh, right, we need to do something about the small banks. They can be dangerous too. We have heard, I think in particular from Irene, that and also from Jens, that there are numerous loopholes, and regulators try to avoid applying bail-in wherever they can. And I think the most egregious of all cases, then the third one is, which hasn't really been discussed today, is Credit Suisse, right? I mean, this is now the poster child example of a big SIFI failure, and we have a bail-in regime in Switzerland, and they don't really apply it. They tailor-make a regime over one weekend specifically for this bank, and all the expectations of applying a legal regime, of testing it for once, come to nothing, right? So my provocative question to all of you, and I'd like a quick statement from each of you, is, how reliable is that legal framework that we are building, and how reliable will the CMDI be? And maybe Hilmar can be quite relaxed, because it will not really be applied in the way. So my point is, put more simply, is there's always those good intentions in building new regulations, but will it really stand the test of applying it in practice, or is the system sometimes politicized or driven by other motivations? Maybe we go a quick round, and starting with Jens.
Right, thank you. I think it all depends on which perspective you look at this, right? I think while we all agreed in 2014 that something needed to be done about the large banks, we cannot agree anymore what is really the problem, right? I don't even think that all European member states agree that small banks are the problem. As we've heard from Hilmar, in this country they are not. And the perspective will change depending on which market structure you have. If you have a country with very few banks under the auspices of the SRM and the SRF, then the perspective is entirely different from jurisdictions where 90% of all banks are within that frame. I mean, and where it comes out quite clearly is in the Commission proposal, which are very outspoken when it comes to discussing the need to unlock funds, to opening up the scope for resolution, and which turn very vague when it comes to how exactly those funds will be used, and why exactly it is that we need to expand the scope of resolution across the board.
Thank you very much for this indeed a little bit provocative question. But again, I would like to put it into perspective. Yes, there were at European level...
Personal statement, Karl-Philipp, nothing official from the SRB.
No, of course, I'm very descriptive. So we have, over the 8 years at the European level, we have 2 positive resolution decisions. Basically, the Banco Popular, 4th biggest bank in Spain, and then we have a cross-border banking group with Sberbank. These are 2 resolution decisions. I would say, do we really want to have 3 or 4 resolution decisions every year so that we can boast we have had 25 in 8 years? I don't think so. Frankly, you turn it the other way around and you say all the regulatory reform which has been taking place after the great financial crisis has made the European banking system more resilient, as we have seen, I think, also last year after the banking turmoil in Switzerland and in the US. And basically, this has actually not made it necessary to intervene with resolution. And let's not forget, resolution is about distributing losses in a society. It's not a kind of, just let's do it because it's nice to have. It's a safety net. So I would say that's my take. I don't say much about Switzerland. I can only say about Switzerland that the fire was extinguished. And I think that is already something which is important. In a way, maybe where the losses were distributed differently than you would have thought before, but the fire is out.
Yeah, thank you.
Yes, of course, I mean, the problem is it's huge, and we have to deal with different countries, different culture. From an Italian perspective, what I learned in my experience and also in my PhD studies, that we faced a lot of banking crises. We have people from the Bank of Italy that I saw down there. And in Italy, before this regime, no one lost €1, never. We always manage banking crisis with deposit guarantee schemes, not only in liquidation, but also before. I mean, so we use a lot of instruments. We had also state aids, of course, that I think that we cannot be absolutely avoided. This is my opinion. When I say that the resolution should be expanded, according to me, it's not like all the banks have to be placed under resolution. I think that if you think to the word crisis, it comes from Greek. crisis was an option. In the sense that it was not so negative, in the meaning, the original meaning was a solution. A resolution is a medical term in the sense that you bring back the bank to a going concern. So I think that maybe if we have these instruments that are able, okay, to save a bank in a way that, okay, doesn't involve public funds, that we share losses between shareholders, and it could be useful. This is my opinion. Not for everyone, not for all the banks, but we have these instruments. Someone told me one day is a Rolls Royce that remain in a garage resolution. Maybe with this reform that has a lot of defects, of course, we can use it more. This is my remark.
I think that it is really crucial and a big success that we have this resolution regime in place, and that it worked when it was tested, even when it was not tested really in a very challenging case, let's say. Because, especially when I look from the industry perspective, because it's the only credible answer we have for crisis. Right? I think probably this framework has weaknesses, and maybe we will detect them through when the next crisis comes. But nevertheless, it's the only credible answer we have for a severe crisis. And we can say, okay, in principle, we have a solution for every, let's say, life cycle of any bank in which economic state ever. To be honest, I'm not so afraid about the regulation. As I said, it is complex, and more complexity would be dangerous from my point of view. But I'm much more concerned when I think about, as I said, governance, cooperation, coordination, really. When we would come to a big European crisis where dozens of European institutions have to work together, I'm not sure if this would work. And banks, maybe let me say this one, banks are required to do stress tests, to test their processes, to test their cooperation, and so on. We need much more testing, practical things to do together. Just to know who is responsible in the other institution is difficult to get the information.
Great, thank you. You've all been very smart and elegant in handling very diplomatic in handling my point. But great, I want to open it up to the audience, and the first hand I see is from Irene, and then maybe you all stand up and introduce yourself, and then direct your question to a specific person on the panel. That would be great. Thank you.
Yes, thank you very much that I can make the start, and thanks to all the speakers for their excellent, thoughtful presentations. Allow me to ask a question that is... Apologies. Serena Grünewald from the University of St. Gallen, for those that do not know me. Forgive me if I ask a question that is only loosely related to the CMDI reform proposals, and I'm addressing it particularly to Karl-Philipp, who won't be very surprised about hearing that question from me. You said resolution is about distributing losses, and with the CMDI proposal, we may see more banks coming under the remit of resolution. Smaller, medium-sized bank where we would think that transfer strategies will be the preferred way to resolve them. We saw in the banking crisis 2023 that these transfer strategies often come with the difficulties that buyers may not pay necessarily a fair price for what they are buying. That's a big discussion in Switzerland with the acquisition of Credit Suisse. We may have similar discussions in the US. Now, my question for you is it legitimate that buyers make large profits while the creditors of the failed bank might be bailed in? Is that something that the resolution authority has to take into account? And is that something that may speak for other transfer strategies to be the preferred solution in a specific case? Thank you.
Just to clarify, thank you very much, Serena, that this question was not known to me before. So you ask a lot of questions, obviously, but we have not discussed this before. I mean, again, it's difficult for me to discuss or to comment on the solutions in Switzerland taken by other authorities, on the US taken again by other authorities. I can only refer to what the SRB in the single resolution mechanism has done. And I think there the answer is very clear. If the bank is sold through a transfer of sale process, there are very clear rules in the SRMR about the marketing process, about prior valuation, and then in particular also about keeping and being compliant with the no creditor worse off principle, meaning that no creditor, no shareholder shall be treated worse through resolution, meaning through the sale of the business, than in liquidation. And I think we have adhered to that in a very strict and very clear way. I think competition is very important for the finding of the right price. And I can also refer only the audience to the recent court judgments, which have clearly had a look at the no creditor worse off valuation, which was run by an independent valuer. And then last November, in a couple of cases, the General Court, first instance, has looked into great detail. I think it's about 350 whatever paragraphs of a judgment, so 80 pages. So they have really done a job of scrutinizing every single aspect of the decision in Luxembourg. And I think this is also something not to be underestimated. And they came to the conclusion that no, in the case of Banco Popular, the resolution action, meaning the sale, was on market terms at arm's length. And I think that is clearly also what we are mandated by the legislators, and I think we will stick to that.
Great. Then next on the list is Christos and then Conchetta.
Thank you very much. Thank you all. Georg, my first answer is to your question, to the panel.
Good.
Yeah, with two legs. One taking up to the answer given by Karl-Philipp, which I would subscribe. Eventually not up to now, but potentially from now on. Another very positive effect of the resolution framework is the fact that through resolution planning, banks have increased their capability to absorb losses. Yeah. So the resolution framework should be seen under its two legs. Yeah. Forget early intervention, which is also very important. Yeah. So it's resolution planning, which has improved. There is no doubt about that. At a cost, at a very high cost. And a second leg in the answer, which is with a bitter tone. Not so many banks needed to be resolved because those who needed to be resolved had already been resolved before 2014. I refer to the 16 cases in Greece within 3 years. I refer to 2 cases in Cyprus, correct, including one with a bail-in, which were all based on legislation which passed in Cyprus over a weekend on the basis of the proposal of the BRRD, and another case, if I'm not wrong, in Portugal. So, as a matter of fact, this kind of cleaning up had taken place at the early stages of the crisis, even before the implementation of the BRRD. Now, I have 3 questions to Irene. I agree with...
Three quick questions. Yes.
1.5 minutes. Yeah. I fully agree with what you said, but there are 3 but. There is no definition of crisis. You are correct. There is no definition anyway of financial stability. There are not many definitions apart from snow. But we have 2 definitions in the BRRD, what is crisis prevention and what is crisis management measures. Yeah, in that respect, this can lead us to what deductively crisis means. My second point refers, and maybe I will stick to that, is that you mentioned, and a lot claim that there is no use of the the insolvency, the winding up tool, yeah, even though this may be correct, and I have seen also in the CMDI framework, it is referred again and again. But if you only check the cases that the SRB has dealt with, yeah, you realize that in the majority of the cases, even for large banks, I mean, those who are significant in the terminology of the SSM, the banks were put into liquidation. Yeah? And my third point is that you are correct in saying that we don't have a distinction of banks within the BRRD SRMR, apart from significant, less significant for the categorization, and you don't have this CRR definition, the less complex, but still you have some proportionality elements embedded. At the beginning, I don't remember exactly the article of the BRRD, with regard to resolution planning, so not all banks are subject to the same rules. Yeah? So I fully agree with what you said. I just wanted to put some qualification eventually for some further thinking. Thank you very much.
Irene? Yeah.
Yes, I like these kind of questions because I really lawyer approach, so, and I really like it. And no, because it is correct. I mean, I had to do a sort of general statement. Of course, there's the concept of crisis. I started from the Italian approach in the sense that in the insolvency procedure, we have different level of crisis. So you have the medium-sized crisis, you have failure, insolvency. In this sense, I say that's not a definition of crisis. Of course, there are levels of crisis also in the BRRD because according to the level of crisis, you apply early intervention measure or other instruments. So it's correct. I was not correct, but I had to take this general approach. And as regards liquidation, I didn't get your point in the sense that, what did you mean? That in the CMDI, they don't talk about liquidation? Or in the sense that there are not proposals regarding the liquidation procedure? Because there, maybe I didn't understand what you wanted to say. That, of course, that liquidation has been applied. I mean, but I didn't understand the question. Maybe it's my... yeah, okay.
In Article 34, the dichotomy is there. It depends on the PIA.
Of course, yeah.
Yeah, positive, negative, correct?
Yes.
But there is a claim that there are so many still impediments in the BRRD SRMR framework which would not allow the decision to be taken that the bank should be led into insolvency, into the winding up procedures.
There are a lot of
claim that, first of all, it does not hold in terms of circumstantial evidence, because in most cases, the banks have been declared as insolvent and no resolution measures were taken. That was my point.
No, but your point is correct, because when the resolution authority has to evaluate the public interest, it has to also to compare liquidation and resolution, and also the no credit words off principle has to be applied. And when we analyze the no credit words off, we have to analyze every national legal framework, and every time is different, because also if you consider the hierarchy of creditors, they are completely different in Italy, and so it's a very, very complex evaluation that Karl-Philipp knows better than me. As regards the proportionality, what I meant is this. We have more proportionality, according to me, in the SSM. In the SRM framework, there's a statement regarding proportionality. Maybe you recall it in your slide, or I read it in your paper. I don't remember the article, it's 35 or 45, something like that. But in reality, this proportionality is not so applicable, at least as regards the MREL. Not only for the approach of the resolution authority, maybe it's my critical approach to the SIB, but in particular for the 8% TILOF. That applies to all the banks, without a distinction regarding their size or their business model. And this is a matter of fact. So not all the banks are in the same situation and can reach this requirement easily. If it's easy, I don't think that it's easy in any case, but the 8% TILOF, it's a problem. Thank you for your question.
Thank you, Irene. Then next on the list is Concetta. And everybody else in the room is invited to contribute, to ask, to come in.
Thank you so much for the very interesting presentation. And thinking about what we discussed 4 years ago also on this topic, where we were not so far from there were no cases at all, I guess, in 2020 of resolution already done in place. And we are starting to discuss. We are in theology faculty today, and I guess that is the most appropriate faculty in which to debate this topic. I don't know why. When we are about to discuss banking crisis, there are some ideological backgrounds that arise. And one point that I cannot understand is one, the goal of those rules is not to enlarge the scope of resolution or the scope or include more banks in a basket or in the other one. This debating how to modify this legal framework is necessary to avoid that a banking crisis could have a negative spillover effect on the whole society. As Karl-Philipp underlined, it's a way to distribute losses and the burden of the crisis. So we should pay attention to this. I don't think that it is important if we use the word resolution, the procedure, or liquidation. The only thing that is important is that this procedure works. And on this point, I would like to ask to you that are so expert, why, in my opinion, one elephant in the room is that why nobody discuss one important choice, I think ideological choice, has made the original design of the BRD to including deposits in the bail-in. Irene underlined this point. I cannot agree more with you with this. Even the European Commission with its act of competition authority, okay, yes, short. Why to include? It's a big mistake, in my opinion. And just if we debate, nobody discuss this point. The SVB case demonstrate exactly this point, including in the bail-inable liabilities deposits. It's a huge mistake, but nobody discussed this. May you answer to this question?
Maybe I didn't explain myself correctly, because I fully agree with you. Because if we touch deposit, it's a problem, according to me. And so we have two problems with deposits here. First, that the resources of deposit guarantee schemes are meant to be state aids. This is TERCAS and everything. We know everything happened afterwards, and no one touched this point that it's out of order, according to me. Secondly, deposits are very delicate because we have to trust. I mean, they have to maintain the trust in the banking system. So to bail in deposit, it's a danger for the financial stability and for the trust that depositors need to have in the banks. Otherwise, we can create several deposit guarantee schemes, but we will never prevent bank runs. I agree with you.
Well, I would take a bit of a more differentiated approach, really. I mean, if you look at the one great case where depositors above 100,000 were bailed in, and even below that threshold, they for some time didn't have proper access to all their funds, namely Cyprus, right? You see indeed a disastrous impact of the bail-in of depositors. So you see that basically you have to couple bail-in of deposits with capital controls in order to stem the tide and to prevent a massive outflow of capital. So there I fully agree. But on the other hand, there's also a case for maybe adjustments in cases where in a given banking system, you can draw a clear-cut line between a very large population of depositors that basically fall below that threshold, unlike the case in Cyprus, and on the other hand, you have a very or comparatively small number of large deposit holders, which could actually pay greater attention to the risk they are facing when investing the money. So I wouldn't really come up with catch-all black and white solutions here. I think there's a case for differentiation, which should be addressed through the calibration of the mandatory thresholds. And I think if we end up in a situation where you have large proportion of depositors falling below the threshold that are covered and are protected, then I don't really think the case is that clear-cut. Can I just pick up in one sentence what you said before, namely that the dichotomy between resolution on the one hand and insolvency liquidation doesn't make any sense. I fully agree with that. I think that's a very important point. It makes sense perhaps at in the case where you have or in the early days, it made sense where you could distinguish between resolution and liquidation solutions for very large, too big to fail banks. But when it comes to smaller institutions, it doesn't make any sense at all. It very much depends on the structure and the composition of approaches in the given jurisdiction.
Okay, point well taken. We have other people. Can you hand back, Claudia, can you hand back the microphone to the gentleman behind Concetta?
Giovanni Bassani from the European Central Bank. Listening to Dr. Zettler, I understood the CMDI will never be approved, at least in the way it is at the moment. And it was interesting to actually hearing you saying that it was enormous, I don't know exactly which word you used, but I mean an enormous change, while Karl-Philipp was basically saying it's evolutionary, not revolutionary. I mean, to be honest, I don't know. I mean, I believe that it will be a minimum necessary to improve the framework, but I understand there are so many opposition that probably will never actually be approved, at least in this way. So I wanted to ask Karl-Philipp, it was also related to the question, the prior question before, on this issue of sale of business, and how you actually value the offer you have. I mean, I thought that's actually also the way I think it was implemented in the case of Banco Popular or this Sberbank case. You basically made a very stark difference. Either you have a buyer or you don't. But actually you can actually set up a bridge bank. I mean, why do you need to sell in 2 minutes? Or, I mean, what the Americans, I mean, I don't know actually how it works, but what the Americans do, they set up a bridge bank, it stays there, the assets are revalued. I mean, in 1 year, maybe it could actually worth much, much more. So I think it's a bit of an indicator of how our framework is still primitive in its development, that we actually don't have a full, I mean, bridge bank, I think would never be discussed to be set up for Banco Popular. I mean, I'm not talking about Banco Popular, I don't know anything about that. But in general, I mean, the framework is much more complex and is already in the legal framework. But then I think the operationalization of this framework in Europe, at least, is so much, not that much advanced.
So would you like to address this comment to somebody specific? Karl-Philipp.
Well, I mean, there are 4 resolution tools, and there is the bail-in tool, and then there are 3 transfer tools, basically. I think what you say is that there were 2 cases were solved with sale of business as the transfer tool. One of them combined with prior write-down and conversion powers. Does it prove anything that, I mean, does it prove that the framework is immature, or does it prove that, I don't think it proves anything in the end. It proves that the tool which was chosen was the one which was most appropriate at the given moment to resolve the bank and to re-establish financial stability. The bridge bank is obviously also an option, which is out there, just as the asset transfer tool. So I think that all the options, the SRB is prepared for applying all the options, which will we carefully examine at each time when a specific bank or banking group will knock on our doors. So I think it's more speculation, but I think really that we are prepared also to apply the bridge bank tool. And all the tools have their conditions, but also their consequences. Huh? I think the bridge bank tool has been applied in other jurisdictions before the BRD in Portugal, let's say here or something. Look also at the SVB, the bridge bank tool was applied because there probably was not buyer immediately, and then it was sold, the assets were sold to a certain price. Serena was critical about it. So maybe other issues will appear, but just again, all the tools are there, and we will apply, the SRB will apply the tool, which will be the tools, because you can also combine tools, the tools, or the tool which is most effective to deal with a specific crisis.
Okay, that was very clear, diplomatic. Hilmar? Yeah.
I think it's not correct that most of the, I think when you look at the FDIC, most of the failures they handle with purchase and assumptions transactions. So the bridge bank is not the rule for the FDIC, but is exemption too, because it's relatively complex to handle. You need to manage a bank and so on. I think most of the crises are managed by purchase and assumptions transactions.
Great. So next on my list is Rolf and then Matthias. Maybe we can take the two of you together because is that okay?
My name is Rolf Seethe, University of Zurich. I have a question to Hilmar Zettler regarding the super preference right. If you look at this right, you are refunded for the money spent within the insolvency proceedings. And if you lose that right of preference, that means your members have to pay higher contributions to the deposit guarantee scheme. And it's that group of market participants that normally should pay for losses. If you look at the hierarchy of resolution, it's first the shareholders that have to pay, and secondly the creditors, and that exactly is now mirrored within the deposit guarantee scheme. It's the shareholders of your banks who will pay more in the future. And I think that's convincing.
I don't think so. I think it's the assumptions that banks pay something and nobody else has to pay is a bit, let me say, naive. At the end of the day, when the costs for banks increase, somebody has to pay the costs, and normally this is something the clients have to pay it finally. So the idea that let the banks pay as much billions as you want to, and it will have no impact on the economic outcome for the clients is, I think, not the right understanding in our economy, right?
Matthias.
Matthias Lehmann, University of Vienna. My question was also pertaining to the super preference, but I would have taken the opposite approach than Rolf.
Very good.
Occasion.
That's the spirit.
Because
highly welcome.
I think it's not, we cannot compare, the right comparison is not to say, okay, it's now like a resolution of the DGS. So the shareholders of the DGS have to pay and the shareholders are the banks. What I would rather say is, so Karl-Philipp in his presentation listed really nicely the options who can fund this, right? And you said, okay, we can fund it from the inside, we can use the depositors, or we can use the creditors, or we can get outside funding. And there you mentioned the DGS, but instead of the DGS, you should have mentioned the members of the DGS, because if you take away the super preference, then it will be in the end the other banks that will have to shoulder this loss, and that means the competitors. And I think here is the real policy question is, should the competitors of this failing bank really pay those who deposited with this bank in an unsustainable business model, maybe benefiting from this, looking at it and not choosing the right bank, and then the other banks should pay up for this. I mean, the other banks don't really have a possibility to influence and to discipline their competitors. They can just do their honest business, and then there is one dishonest bank. Everybody goes there, it goes bust, and then the competitor banks will have to pay for that. That seems to me to be kind of unfair. It also not very conducive to a viable banking landscape in the EU. We have to think about banking needs to be profitable as well somehow. So if you have to pay up for the losses of your competitors, I'm not sure that's the best solution.
Maybe one additional remark. I think the banks in the community, they don't have the opportunity to influence the risk. They have to rely on the supervisor and hope for a good job. But those who make business with these banks, and we do not only always talk about small retail investors, but we talk about big depositors who go intentionally to that bank to get higher rates there and so on. They are much closer to the bank and to the business of the bank than other competitors. So, and is there something different from other companies that when you deal with company, you're in business with company, and a company fails, then maybe you face losses. This is the normal treatment of failure, I think, in other companies and other businesses too. Where's the need for a different treatment?
Jens, you want to comment?
Yeah, can I just add a sentence? I think, Rolf, your point is absolutely valid in payout scenarios, right? But it's much more difficult when it comes to the use of DGSs as sources of funding more broadly. And this is, I think, what we see in the CMDI package, the willingness to activate DGS sources to a much broader use than used to be the case. And I think there the arguments in favor of the super preference are less clear-cut, to say the least. I don't have a definite answer to that, but I think this is something to be borne in mind. You can't detach your point from the discussion as to how you're going to use these funds and to which ends.
Great.
Karl-Philipp, yeah. I would also like to say a word about this discussion actually here. I think you had a nice slide, Hilmar, in the beginning on the principles. Huh? I think there were two principles maybe which we could still add, and I think this is financial stability, which I think we all agree is also one of the key goals of the framework. And I think also in case of the resolution, the decision 10 years ago to have, you mentioned that, not to have bailouts anymore, but basically to internalize the losses and to have the industry and sort of, polluter pays principle as a solidarity community, you said, being together. And I mean, similar discussions which we have with the Single Resolution Fund. Yes, you pay a sort of insurance premium, but you are insured. You are insured either if you enter a resolution, or you are also getting another profit, which is that if a bank is resolved with the use of industry safety net and financial stability is preserved, that profits and that benefits the whole sector. And I think this is a consideration which also plays in here. Now we are talking about national DGSs, and in some member states, DGSs which are again split into different membership groups. Of course, the Commission recently at the SRB conference this week again said that it is where you have the kind of fund, everything is basically mutualized. That would sort of, take away this problem. But I think this comes simply with having a national system, a decentralized system coupled with the European system. Both basically are based on the idea of achieving financial stability and providing also a benefit to the community, exactly, this is the right word, the community which is creating a certain risk.
Okay, that was clear. I mean, I think, you know, I think Hilmar's point was that every insurance comes with a side effect, right? I mean, that's, of course, the moral hazard problem, but we don't have time to go into a lot of detail with that. We are close to the end. I wanted to close this panel with another controversial round, maybe, to finish us off on a lively note. And going back to, I think it was Karl-Philipp who had this ceterum censeo point, which, however, ran through everybody, right? One of the big problems is the disparity in national insolvency regimes and the combination of having a European scheme and then lots of national schemes alongside one another. Now, my point is to everybody of you, isn't there also a positive thing about having some variety? Isn't there some benefit of experimenting in different countries? And shouldn't we try to see what works, right, and what doesn't? And then countries can experiment a bit, and, you know, those countries that experiment with too many protectionist measures may have a competitive disadvantage in financial stability in their country. So my plea would be to say, let's see what works. Let's allow some competition between national regimes, and let's not harmonize too much. And for that final round of statements, I start at the opposite end, Hilmar, and then we go through here.
Well, to be honest, financial stability is really an important good, and I'm a bit afraid of doing too experiments with that, so I would be rather careful. But I think we have sometimes the discussion in the community, or we heard today several times, the third pillar is missing. Maybe other pillars are missing too. So we say something, well, in principle, maybe we do not have a pillar that some people expect, but we have a harmonized deposit guarantee landscape in Europe that is maybe all DGS together, the third pillar of the banking union. And we have a very, I mentioned already, I think the state of development of the DGSs in Europe changed fundamentally through the DGSD. You can't compare the situation today with the situation we have 8 or 10 years ago. And there's really a strong cooperation between the DGSs, and there is an extensive exchange of views of processes, tools, and so on. So there is an intense cooperation already that ensures the further development of the whole community. And maybe that's the better way for avoiding the damages of experiments.
Okay. Irene?
Yes, more than experiments, I would say practice. So we have to see, of course, if we don't apply the system, we will never see if it works or not. But of course, we have different systems that they have to live together. And in the future, maybe we have to see how much solidarity we want to apply in the system. And also, maybe I think, maybe Jens is better to answer this point, is the harmonization of insolvency procedure is one of the key points, and maybe a functional approach in the sense of to harmonize at least the objectives of this procedure would be a big step towards, a system that might work in the future.
Thanks for this provocative question. Indeed, I think it's important you don't do regulation just for the sake of regulation or harmonization just for the sake of harmonization. Where it's not necessary to make a rule, it's necessary to not make a rule, in my view. So the basic policy question is always, what is basically giving more welfare gains? Is it not to have leave the insolvency regimes as they are, or maybe harmonize them in order basically to create legal certainty and to enable a full internal market? And I think this is, for me, the answer to be given. I think also we have come a long way already. So we are talking about things which are necessary, but we already should not forget we have already come a very long way.
Thank you. If I can just start with, and not start with a caveat. I think you need to be very careful what you're talking about when talking about the harmonization of national insolvency regimes. If you talk about the triggers for entry into liquidation on the one hand and the hierarchy of claims on the other hand, then I think harmonization is urgently needed. This is also something that is needed in order to operationalize the no creditor worse off test, basically, without having to think about different regimes in all participating member states. On the other hand, if you talk about national liquidation regimes for small and medium-sized banking institutions, I'm absolutely with you, because these regimes tend to be either tailored to the specific market structures, which may be hugely different, or they can be adjusted to those market structures easily without involving European regulation. And there, I would say there is a definitely a case for refraining from further harmonization, other than by way of maybe functional harmonization in one way or the other.
Wonderful, many thanks. You see the curtain is closed and all the questions are open. So thank you everybody on the panel for terrific contribution to this discussion, and thanks to everybody here in the audience.